They told you the market sleeps, that when the last trade settles, the risk is over, the story is done. But they never mentioned this part, the part where prices keep moving, where billion-dollar positions shift, and where deals happen far away from public eyes. It's a window of time most investors will never access, and by the time you see the morning prices, the real money has already changed hands. This isn't some conspiracy theory, it's a system built to operate in the dark for those who know how to play and for those who can afford to lose big. This is the after-hours market, and everything you thought you knew starts after the closing bell. They say the market closes, but that's not entirely true. When the official session ends and the screens go dark, a different market quietly comes to life. No ringing bells, no TV anchors shouting breaking news, just numbers flickering on private terminals in rooms most people will never see. This is where the after-hours market begins. Unlike the daytime market, this is not a public arena. It's a fragmented network of electronic communication systems known as ECNs, private platforms where trades continue long after the headlines stop. But here's the catch. Liquidity vanishes. With fewer buyers and sellers, every trade has the power to swing prices dramatically. A single large order can send a stock soaring or crashing in seconds. Bid-ask spreads widen. What you're willing to pay and what someone's willing to sell for suddenly become two very different worlds. And there's no safety net. During regular hours, market makers, institutional funds, and millions of retail traders help balance prices. But after hours, that balance disappears. There's no guarantee you'll find a counterparty, no guarantee your trade will execute, and if it does, there's no guarantee it'll be at a price you recognize. Most brokers only allow limit orders at night. That means you must name your exact price and hope someone out there agrees. Place a market order after hours, and you're playing with fire. You could wake up the next morning with a position filled at a price you never imagined. But why does this market even exist? Because critical information doesn't wait for the opening bell. Earnings reports, corporate announcements, economic data, they're often released after the regular session ends, by design. And the players who move fastest in these moments, they're not random retail traders on a mobile app. They're institutional investors, hedge funds, high-frequency traders, armed with algorithms and direct connections to liquidity pools that retail investors will never touch. While most people sleep, these players are reacting to breaking news, repositioning portfolios, and setting the tone for the next day's open. By the time the average investor logs in the next morning, the real moves have already happened. Prices may gap up or down, reflecting decisions made in the shadows. And there's another layer most won't notice. Price discovery itself changes. During normal hours, regulations like the National Best Bid and Offer keep prices aligned across exchanges. But after hours, that coordination fades. Each ECN shows its own prices, disconnected from the others. One platform might show a stock at $100, another could show $102. The truth? Somewhere in between, or nowhere at all. For those with the right tools, this fragmentation is an opportunity. For everyone else, it's a guessing game. So while the world assumes the market is sleeping, money continues to change hands, risks multiply, and the price you see in the morning often hides a story written overnight. But the real question isn't just what happens in these silent hours, it's who is making it happen. Not every investor gets to play after hours. While millions of retail traders log off, a different group stays connected. These aren't casual investors reacting to headlines. They're professionals with both motive and means. At the heart of the after-hours market are institutional investors, hedge funds, pension funds, private equity firms, entities managing billions, sometimes trillions of dollars. They don't just trade, they position, they hedge, they react to information long before it filters down to the public. And then, there are the high-frequency trading firms. Operating at speeds measured in microseconds, these firms deploy algorithms designed to exploit even the smallest inefficiencies in after-hours pricing. When liquidity is low and spreads are wide, speed becomes a weapon. A well-timed order can push prices just enough to trigger stop losses or scoop up shares before the rest of the market even notices. For them, volatility isn't a risk, it's the goal. But institutions and HFTs aren't the only players. Corporate insiders, executives, board members, sometimes execute trades based on scheduled events like earnings releases. Legally, they can trade after hours, as long as they comply with disclosure rules, but timing matters. When a company releases earnings at night, insiders and fast-acting funds are often the first to move. And then there's the news flow. Press releases, mergers, CEO resignations, product failures. Most of these announcements are strategically timed after market close, giving institutional players time to react in low-visibility conditions, while the general public sleeps. For example, when Amazon releases earnings after hours, it's not an accident. It's part of a carefully designed information strategy. The company knows that reactions and after-hours trading can set narratives for the following day. A single sentence in an earnings report can trigger millions of dollars in trades before the sun comes up. But there's another layer: dark pools. Some institutional trades happen in private exchanges not visible to the public quote stream. Even after hours, these dark pools remain active. Orders don't appear on standard Level 2 screens. The volume moves, but you won't see it until later, if ever. The combination of fragmented ECNs, private dark pools, and high-frequency algorithms creates an environment where price discovery becomes a shadow game, one driven by speed, privilege, and information asymmetry. And yet, the system allows it. Regulators permit after-hours trading. Brokers provide limited access to retail clients, often with severe restrictions. But the real edge remains with those who understand how to navigate the fragmented, illiquid, and volatile night market. So next time you see a stock open 10% higher or lower, ask yourself, who made the first move? Who set the tone while the rest of us weren't looking? Because in the after-hours market, information isn't just power, it's profit. For most investors, the market is a scoreboard. You check the price, you see the change, but what you don't see is how that number was built. And after hours, that gap in information gets even wider. Unlike regular trading sessions, where real-time data flows constantly and liquidity smooths out the noise, after-hours trading exists in a kind of informational fog. Prices move, but not everyone sees why. Corporate earnings, for example, are one of the biggest drivers of after-hours volatility. Major companies often choose to release earnings after the market closes. Why? Because it gives them control over the narrative. By releasing results after hours, companies can process investor reactions without the chaos of daytime liquidity. They watch how the big players move first, they let the price settle in the shadows, and by the time the opening bell rings, the narrative is already shaped by funds and traders who had early, unrestricted access to react. And it's not just earnings. Regulatory filings, M&A announcements, executive resignations, credit downgrades, all of these are often timed for release after market close. And the people with the fastest terminals and the best data feeds, they're the ones reading and reacting minutes, sometimes seconds after the news hits. Retail traders, they're left chasing headlines. But there's another layer: Data quality. After-hours price data is notoriously inconsistent. Because trades are spread across multiple ECNs, there's no unified tape. A stock may appear to trade at $100 on one platform, 101 on another. And if you're looking at a retail trading app, the price you see might already be stale by the time it reaches your screen. Worse, some brokers delay after-hours data feeds by several seconds, sometimes even minutes. That's an eternity in a low-liquidity, high-volatility environment. And then comes the volume trap. A price move after hours might look dramatic, but look closer, and you'll often see it was based on just a few thousand shares. That's all it takes to create a gap when liquidity is thin. By morning, that move might vanish, or it might snowball as the broader market reacts. Either way, retail investors only see the aftermath, not the setup. This is the information gap, a structural delay between cause and effect, between those who act and those who only watch. Because in the after-hours market, it's not just about price, it's about who knew, when. In the after-hours market, price movements don't drift, they snap. What looks like a minor news headline during the day becomes a grenade at night. One trade, one whisper, one unexpected announcement, and the entire price structure can collapse or explode in seconds. Take NVIDIA, for example. After releasing earnings late one night in 2019, the stock surged nearly 6% within minutes. Trading volume spiked, screens lit up, but by the time the regular market opened the next morning, much of that gain had already vanished. The public saw a headline. The insiders felt the full storm. And NVIDIA wasn't alone. After-hour sessions have become famous for these sudden, violent swings. Why? The answer is simple: thin liquidity and unchecked speed. With so few players in the game, a single large order can send a stock soaring or crashing. There's no deep pool of buyers and sellers to absorb the impact. The market becomes brittle, fragile, easy to move, and easy to manipulate. This is where high-frequency traders thrive. Armed with algorithms that react in microseconds, these firms aren't just responding to market moves, they're creating them. They flood ECNs with orders they never intend to fill. They layer bids and offers to confuse other algorithms. They cancel orders faster than any human could react, creating a false sense of supply and demand. It's called spoofing, it's called quote stuffing, and it's all legal until it isn't. The 2010 flash crash was the most infamous example. In less than 5 minutes, the Dow Jones collapsed by nearly 1,000 points, erasing almost $1 trillion in market value, before bouncing back just as fast. Investigators later traced part of the chaos to one man, Navinder Singh Sarao, operating from his home in London using spoofing algorithms to distort the futures market. But here's the uncomfortable truth. Smaller flash moves happen all the time. You just don't hear about them. A late-night earnings miss, a sudden downgrade, a corporate executive stepping down unexpectedly. In after-hours trading, these moments don't unfold gradually, they hit like a hammer. And often, the price you see when the market opens in the morning isn't a fresh discovery. It's the result of hours of chaotic, low-volume, high-volatility trades engineered in the dark. Retail investors log in. They see the gap. They feel the fear of missing out or the panic of being caught off guard. But by then, the game is already over. Because in the after-hours market, flash moves aren't accidents. They're part of the design. Most investors like to believe the market is open to everyone. That with the right app, a few clicks, and a little courage, they can play the same game as the big players. But when it comes to after-hours trading, that illusion falls apart. Access starts with your broker. Not all of them offer after-hour sessions. Some open the door only partially, limiting which stocks you can trade, what types of orders you can place, or how much volume you're allowed to move. Market orders? Forget it. Most brokers only accept limit orders after hours, forcing you to guess the exact price you're willing to pay or risk getting nothing at all. But even if you get through that first layer, you're still trading blind. During the regular session, every quote you see reflects a consolidated market, multiple exchanges linked together, offering the best available prices. It's a safety net. After hours, that net disappears. Each electronic platform shows only its own prices, no obligation to reflect the best bid or best offer from anywhere else. You think you're seeing the market, but you're not. You're seeing one sliver of it. And that's just the start. Data speeds slow down. Quotes lag. In some cases, the price on your screen is already outdated by the time you react. Meanwhile, institutional traders, armed with direct data feeds, co-located servers, and lightning-fast execution systems, are already acting on information you won't see for seconds or minutes. Then comes the liquidity problem. With fewer participants and fewer orders, the distance between the highest buyer and the lowest seller widens dramatically. The spread grows. That means if you want to buy, you'll likely overpay. If you want to sell, you'll accept less. There's no crowd to protect you, no depth to cushion the mistake. And while you hesitate, someone else, faster, better equipped, and fully aware of your disadvantage, is already filling your gap. It gets worse. Some brokers automatically cancel any unexecuted after-hours orders at the end of the session. Others limit how many shares you can trade, or which stocks you're even allowed to touch. And while retail traders navigate these restrictions, institutions operate freely. They move blocks of shares across multiple venues. They execute cross-platform arbitrage. They adjust portfolios in ways that leave no public trace until the next morning's opening bell. Even corporate insiders, when legally permitted, execute strategic trades in these windows before the rest of the market can react. The playing field isn't just tilted, it's vertical. Still, some retail traders are drawn in. They see opportunity and volatility. They hope to catch a pre-market breakout, to front-run a big earnings surprise, to turn timing into profit. But most are chasing shadows, acting on stale data with poor execution and without the tools needed to survive in this environment. After-hours trading is a world designed for those with speed, infrastructure, and insider positioning. For everyone else, it's a dark room with a loaded trap. So yes, technically you can access it, but the real question isn't whether you're allowed in. It's whether you're prepared for what's waiting on the other side. By the time the sun rises, the real game is already over. While most investors are pouring their first cup of coffee, unlocking their phones, refreshing their apps, the damage, or the setup, has already been done. The prices they see aren't starting points. They're the end result of hours of unseen negotiation, silent battles, and calculated moves made in the dark. When the opening bell rings, the market looks fresh, clean, balanced. But that's just surface tension. Because overnight, behind closed systems and fragmented exchanges, the players with access have already positioned themselves. They've reacted to news before it became news. They've moved size without leaving a visible footprint. They've pushed prices where they needed them to be. And what does the average investor do next? They trade inside a reality that was written hours earlier. Every morning gap, every sudden spike, every unexplained dip, they all carry the fingerprints of after-hours decisions, fingerprints that most will never see. It's easy to forget this, to look at the day's chart as if it starts from zero, to believe the opening price is just a reflection of supply and demand, shaped in real time. But the truth? The most important chapter already closed, before most people even woke up. Because the after-hours market isn't just a time slot, it's a filter, a silent editing room where the next day's narrative is written, shaped, and sometimes manipulated. So next time you check your portfolio first thing in the morning, ask yourself, are you reacting to the market or just playing catch-up in a game that was never built for you?